With the S&P 500 trading at all-time highs and a lot of these AI tech stocks taking off in a major way over the last few months, there's a lot of conversation about whether this is an AI bubble. And something to keep in mind when it comes to bubbles is they pop very quickly and very violently. So the three stocks that we are looking at today are small to mid-cap stocks in very defensive industries that could capitalize on a certain number of catalysts over the course of the next 1 to 2 years. And the first company we have up here is Copart, ticker symbol CPRT. They have a market cap of $42.9 billion. And over the course of the last year, the stock price has fallen by over 15%. They hit a 52-week high of around $64 per share. And from that point till now, the stock is actually down by over 30%. And what exactly does Copart do? They are a wholesaler auction company for vehicles. So basically what that means is car dealerships can come onto Copart. They can look for vehicles to actually resell at their dealership. Sometimes these vehicles have extensive damage and they need to fix them up before they sell them. In other instances, they are basically in a condition where they can roll them onto their lot and start pricing them. And the reason that Copart's stock price is down so much in the last 6 months is because over the last 2 quarters, they have posted slower revenue growth than investors have been anticipating. Back in May of this year, they posted revenue of $1.2 billion, an increase of 7.5% year over year. In the most recent quarter, they posted revenue of $1.1 billion, increasing only about 5% year over year. And this is a growth rate that compared to the previous 2 quarters is about half of what Copart was seeing. So this is a big concern for investors. We can see that over the last 5 years, they have experienced a massive increase in revenue. Back at the start of 2021, their trailing 12-month revenue was $2.3 billion. That has since increased to $4.6 billion. And throughout 2021, they were seeing 30 to 40% increases in their total revenue. However, keep in mind that during this time period, everyone was buying used and new vehicles. What I would anticipate to occur over the next couple of years is if we see interest rates start to drop, a lot of these people that were buying cars back in 2021 may look to purchase new vehicles. Right now, people looking to finance a vehicle are paying very high interest rates, anywhere from 10 to even 20% in some cases. So as we see these rates start to drop for new car loans, we could see a lot of people looking to purchase new vehicles, especially because over the last couple of years, new vehicle purchases have really bottomed out. And what I would anticipate is this having a big effect on Copart. And honestly, even if this doesn't play out, Copart should still do okay. They have done a great job of growing their bottom line numbers over the last few quarters. Despite them only growing their top line by 5%, they saw year over year their EPS in the most recent quarter increased by over 17%. And right now, the company is trading at a forward P ratio of about a 25. This is basically in line with the broader market. However, if you look at itself just a few months ago, it was trading around a 30 to a 40 forward P ratio. So the valuation is actually down comparatively to where it has traded at in the past. So when I look at Copart, you're getting a defensive company that has the ability over the next 1 to 2 years to increase by 50 to 60% just to get back to all-time highs. So I think this is a very interesting company, and I think it has potential to even do better than that over the next 2 to 3 years. The next company we have up here is Procore Technologies, ticker symbol PCOR. They have a market cap of $10.5 billion, and over the course of the last year, this stock is up 11%. However, they hit a 52-week high back in February of around $90 per share, but from that point till now, the stock is down by over 20%. But what exactly does Procore Technologies do? Well, they are a construction management software company. Basically, all of these developers and general contractors are looking to use different software to actually manage their projects. And what they need to manage is timelines, budget, quality, and safety metrics. So they would like to do that on one platform, and that's where Procore comes in. in. And in Procore's most recent earnings announcement, they put up revenue of $324 million, dollars, an increase of 14% year over year. They also provided guidance for the full year of growing their top line by around 13%. And of course, 13% growth is not a crazy high growth rate. However, what this company is primarily focusing on is trying to reach profitability. They got very close September of last year, and the company does appear to be trending back that direction over the last couple of quarters, but they really need to break through to become a profitable company and sustain these kind of mid double digit growth numbers. If they can keep growth at 10 to 15% and get to profitability, this is a company that should see a lot of growth in their stock price. And again, this is a bit more of a defensive play. If we see interest rates start to drop, a lot of companies have actually pulled back on their capex spending over the last few years. So if we see these interest rates kind of drop out and maybe some government funding come into road work and other types of projects like that, we could see Procore actually take off in a major way over the next couple of years. Again, because over the last couple of years, we have seen this kind of cooling off of these types of projects. So again, that is Procore, a construction management software company that is a little bit more on the defensive side of things. And this last defensive company that we have up here is Craneco, ticker symbol CR. Over the course of the last year, this stock is up almost 16%, and they have a market cap of $10.5 billion. And what exactly Craneco does is they produce mechanical equipment for a number of different industries. Their business is split up into two main segments: aerospace and electronics, as well as process flow technologies. Within their process flow technologies unit, they are producing valves, pumps, lined pipe, instrumentation, and controls. And again, this is a play on industry really taking off over the next couple of years. If we see this pullback in interest rates, a lot of these companies are going to look to reinvest into their business through capital projects. And when they do these capital projects, they're going to need things like valves, instrumentation, whatever it may be to actually execute them. The other side of this is if we see tariffs kind of take off the way that they have, this could incite a lot of businesses to driving some of their industrial manufacturing back to the US, thus having an effect on companies like Craneco. In the company's most recent quarter, they posted revenue growth of 9.2% year over year, with GAAP EPS growth of 20.2% and non-GAAP EPS growth of 24.2%. This is one of those companies where I don't expect it to grow by 20+%, but if they can sit in that 7 to 12% top line growth and continue pushing efficiencies at their bottom line and growing by 15+%, the stock price should do very well over the next few years. And honestly, the good thing about it is the company is aware of this. They know how they need to grow. They are not going to see significant organic sales growth. What they really need to focus on is mergers and acquisitions and making sure they execute those at a high level. And by a high level, I mean they need to make sure that they are getting very nice returns on capital when they are actually making those acquisitions. Don't just buy a company because they want to add them to their portfolio. They need to buy them because they can actually help them grow more significantly and more quickly, as well as translating some of that growth to their bottom line through better margins. Right now, I wouldn't say this company is trading at a discount. Its forward P ratio is sitting at a 27. This is basically in line with where it is traded at over the course of the last year. But what I think is really the benefit for this company is continuing to grow their EPS. It's one of those companies where as long as they translate this growth to their bottom line and they see 15, 20, maybe even 30% bottom line growth over the next couple of years, that will translate to higher stock prices. And right now, analysts are anticipating around 12% growth year over year from 2025 to 2026. For 2025, they're expecting EPS on a non-GAAP basis to come in at $5.77. And then in 2026, they're expecting that to grow again by about 12% to $6.47. So personally, I do not own any of these companies, but out of the three, the one that I find the most interesting is Copart. I think they have the most solid business model. I think there's a lot of potential upside with people purchasing new or used vehicles over the course of the next 1 to 2 years. And I also think their valuation, again, it's trading at a lower level than what we have historically seen for the company. So all of those factors provide a little bit of margin of safety as well as a lot of potential upside. But let me know in the comment section which of these three companies are you most interested in. Again, this is a little bit different because these are not necessarily growth companies, they're a lot more defensive minded. So if you think there's going to be a pullback in the market, these three companies could be good ones to look into and potentially add to your portfolio to kind of defend against those potential pullbacks. But again, let me know down below your thoughts. And while you're down there, drop a like on the video and subscribe for more videos like this one. And as always, have a wonderful rest of your day.